Yeah, I think if we look, today versus a year ago is remarkably consistent, and that's consistently tight. So we're in a very, very low vacancy rate environment, and that subsequently has driven rents up 20% from this time last year to an average now blended rate of 210 dirhams a square foot per annum across the whole city. If I'm talking to an occupier, I would say plan early or pay later.
If I'm an investor and I'm looking to buy, it would be do your due diligence, look at the developer, who are you buying from, where are you buying, which part of the city.
Hello, everyone. Welcome to the second episode of Cushman Wakefield Core Conversations podcast. Today, I'm joined by Charlie Sargent, our head of Global Occupier Services, and Rob Thomas, head of agency. Welcome both.
Thank
Morning.
you. Good to be here.
Good to have you. Before we kick off, can you please tell our audience a little bit about your respective roles, how they differ, and just a little bit about your experience in the market?
Sure. I think fundamentally, Rob and I operate in very similar brokerage capacities. The difference between, the main areas that GOS kind of work on is probably a differential in service and client base. So client base, we exclusively tend to work with multinational corporates. They come from the Cushman Wakefield network. They feed into the UAE market or the MENA market, where we handle those transactional requirements. In terms of services, we tend to be more embedded into the client from sort of ideation, initiation of the strategic projects that we're working on, all the way through to the end result. But predominantly exclusively on the tenant corporate rep side of things.
Brilliant.
So we do tenant reps similar to Charlie, but I guess not so much on a Global Occupier Services mandate. It's more local and regional tenant rep. But we also help buyers, sellers, and landlords. So I guess our businesses are complementary, but slightly different in terms of the scale of tenants that we're working with and the fact that we also help, as I said, buyers, sellers, and landlords.
Thank you for explaining that. That's clear to me. Can you tell us a little bit about your experience in the Dubai office market?
Sure. So I'm lucky enough to have been in Dubai since 2006. This year is my 20th year. Majority of that time spent in commercial real estate. I've been with Cushman Wakefield Core since 2018. So I think that's 8 years this year. And most of my time in Dubai spent in the commercial real estate industry.
Right. And Charlie?
Yeah, similar. Came in 2008, but I wasn't working. I was schooled and educated out here. But I've been working in industry for the last 10, 11 years in corporate tenant rep and with Cushman Wakefield Core for the last 2.5 years.
I think, unfortunately, I've shown my age difference between myself and Charlie. Saying I've been working since 2006 and Charlie was in school since 2006.
I'm not going to comment on that.
Okay.
And just to set the scene for today's conversation on the office market in Dubai, how would you describe the market today compared to a year ago, let's say?
Yeah, I think if we look, today versus a year ago is remarkably consistent, and that's consistently tight. The occupancy market across the whole city is around 93%, and in the grade A submarkets, 97%. So we're in a very, very low vacancy rate environment, and that subsequently has driven rents up 20% from this time last year to an average now blended rate of 210 dirhams a square foot per annum across the whole city. There is new supply coming. Around 1.6 million is expected this year, which is good news. But the underlying kind of overarching theme is that it's going to continue to be higher rents and low vacancy environment.
Yeah, I think, look, it's worth adding that 1.6 million square foot that is being handed over this year. Lots of that is already pre-leased. So while sometimes you read the supply numbers and they look like, wow, great, 1.6 million is coming, we already know that, again, it's been very strong pre-leasing. We can cite examples of DIFC Square, where I know Charlie's done some transactions. That building will come to market, but it will come to market basically 100% leased. Yeah. So sometimes we read these numbers and supply looks great, but behind the scenes, it's either been pre-leased or there's pent-up demand for that new supply.
Thanks, Rob. We've seen significant increases in rents across much of the Dubai office market. And where are you actually seeing the most pronounced growth, and what's actually underpinning it?
So I think the growth has been across the board, rising tides. So every district that we track has really done well. Perhaps some of the more pronounced areas coming from higher bases, catch the headlines. DIFC, D3, downtown, but also some of the secondary and tertiary areas have also seen significant increases. Business Bay, if I look back at COVID, I look at, the low point of the market, some of those buildings are 100% higher, right? So that's a significant increase over 5 years. Where's it being driven from? I think the UAE, the country, and Dubai done such a good job of saying, come and set up in Dubai. There's no shortage of companies, both global and local, looking at Dubai as their regional base. And that continues to be the case. So it's regional demand that we see. I'm sure it's global demand that you see. And it's all these key factors that Dubai, again, done such a good job of saying, come and set up here. Whether it's the infrastructure, the schooling, Emirates, the network, everything. It's all just saying, this is the place to be globally. I'm sure you see the same from your global clients.
Yeah, I think roughly broad stroked rents across the board, that's the supply and demand dynamic. But we are definitely seeing those peripheral tertiary areas picking up. And that's because, certain occupiers, multinational and, more local regional firms are being priced out of the CBD areas where rents have gone up by over 100% over the last 4 or 5 years. So it's definitely an interesting time.
It's a challenging time, right? I think to be a tenant, because when we talk about the office market, we very often, it's a tenant bias. I know from your side, it's a tenant bias, but because we advise landlords and we advise sellers and we advise buyers, it depends on whose perspective you look at it. So we tend to look through the lens of an occupier, it's a tenant and it's challenging. Arguably, if you're a landlord, it's a very good time to be a landlord, right? So just want to frame that as well, that we have this tenant bias, but again, great time to be a landlord, good time to be a seller, challenging time to be a buyer maybe as well, yeah.
Got it. And you did mention constraints. So I'd like to touch on that if that's okay. There's been lots of commentary points to supply constraint,
Yes.
particularly when it comes to high quality stock. How real is that constraint? Where is it being felt the most?
It's a very real constraint. Particularly from my side, we work with purely multinationals. They tend to find themselves in free zones, major free zones like the Dubai Internet City. The supply constraints there are very real. We're representing many businesses that are looking for expansion space, but simply can't find it. We do have these headlines of more supply coming in, but there's many layers that come with that present many challenges. It could be from a timing perspective, existing lease expiries don't align with delivery schedules. You've got trade licenses. So Dubai is quite unique in the aspect that a certain license can dictate what real estate you can lease. And then cost. Cost has gone up significantly since post-COVID era. We're now 5-6 years post-COVID. That was a much softer market. The typical lease duration is 5 years. So we're now coming up to lease expiry in events where you're trying to talk to these multinational headquarters and explain to them that rents have risen over 100% across the board in many respects.
I don't think anyone budgets for that, right? If they've signed a lease 2-3 years ago, even let's not say COVID is in the past, but even 2-3 years ago, and you say, well, there's 20% increases year on year for the last 3 years. So your rent on average is 60% higher. People are not ready for that kind of news. So I think those are the awkward conversations Charlie has to have with some of these clients where we're probably one of the only global cities that's really seen that kind of, I think, aggressive increases, right? So
definitely over the same time period. Yeah.
Okay. And so we're talking about what we've seen in the last few years or since COVID. What about looking ahead? How do you see supply evolving over the next 3 to 5 years? And what does it look like for occupiers and landlords?
We expect around 15 million square foot to come into the market over the next 5 years. 5 years, yeah. But I think that headline supply it doesn't fully alleviate all the pressures that exist. 50% of that 15 million is free zone. Like I just said, that presents many challenges with trade licenses. And then if you break it down further, you've got 65% of that being single owned and 35% being strata title. Strata title in the corporate, occupier representation world presents many challenges. And it's still sort of unknown whether those strata developments that are being sold off plan now are going to be used by end users or their investors. So that might dilute it even further.
Yeah, again, I think just to reiterate what Charlie said, sometimes those headline numbers, people say, well, if there's 110 million today and there's 15 million in the next 3 to 5 years, surely we'll be okay. But Dubai is so segmented and so clustered and driven by the license that supply in DIFC, if you're registered in Dubai Internet City, that supply isn't necessarily going to help you. So it's understanding the nuances that, each cluster has its own supply and its own dynamics. And again, space in downtown or space in Business Bay isn't going to benefit you if you're looking to expand in Dubai Internet City.
Yeah.
So it's just understanding those differences.
You can make those movements. You can migrate free zones, for example, but it's a time
Time-consuming,
intensive.
yeah, and
it
there's
can
costs
be
involved.
costly
Yes, yeah.
to transfer visas. It's a whole administrative process.
Yeah, and it's that if you're in a cluster that's designed to be in a cluster like an internet cluster or a tech cluster, and all your peers are there, and you want to be with those peers, you won't necessarily then shift into a non-tech cluster. You want to stay within your cluster, I think. So that affects it as well.
Well, that makes sense. Despite higher rents, demand has remained resilient. Can you tell us what is keeping occupier demand so strong right now?
Yeah, I think occupiers probably globally look at the world and then they look at Dubai and say, Brand Dubai's done such a great job of saying, come and set up your business here. Ease of business, infrastructure, talent, all these things are making Dubai probably one of the standout global cities. And that's not changing for the foreseeable future. So it's just meant that the demand has remained strong. Supply isn't really changing in the next 12 to 24 months. And yeah, as Brand Dubai does such a great job, it just keeps that demand moving. I'm sure Charlie sees something similar with his global clients.
Yeah, well, yeah, I think fundamentally it boils down to the UAE. Those structural changes, deliberate kind of economic diversification that they've done throughout the city through enhancing legal and financial frameworks. And certainly there's an aspect of lifestyle and talent. Corporates tend to follow where human capital want to be. There's so many reasons why the UAE is attractive. It's a low tax environment. It's incredibly safe. It's sunny all year round.
Yeah, it helps.
It definitely helps, doesn't it?
Yeah.
So yeah, look, there's many reasons. And all those things boil down to give corporates much more confidence to actually grow and expand here in the region. The UAE as well is probably battling less with geopolitical events that other kind of major cities around the world are challenged with at the moment.
I think Dubai and UAE generally is so good at realizing that there's opportunities and pulling triggers much quicker than most of the cities or other countries can.
Speed of doing business.
Yeah, speed of doing business.
Less bureaucracy.
Less bureaucracy, less red tape. If they want to do something, they do it and they execute quickly. And I think, global companies look at that and say, this is the place to be. And once the big corporates come here, it drives everybody else because they have supply chains.
Yep.
So if I'm a Microsoft supply chain partner, I want to be next to Microsoft, whoever that Fortune 500 company is. So I think bringing the big guys, and Dubai does that very well through incentives and clusters and free zones, and everybody else follows, and then it trickles down from the SME sector, which really drives the economy, and then everybody benefits. So, yeah.
That's great. You did sort of answer my next question. I was going to touch on that global demand, and it's clear that it's being driven into the UAE. And you've kind of talked about what's driving it. But are you seeing any specific sectors or any specific regions in the world that are being attracted to the Dubai market?
I mean, from my side, I'm seeing a lot of American corporate activity, it's always been there, but I've definitely noticed in the last 24 months a real pickup and noticeable difference between kind of the APAC and EMEA markets. Europe is always there and APAC is always there, but the American corporate activity has been by and large the most significant. In terms of sectors, financial, legal, professional services has done particularly well in the last 24 months.
Yeah.
The TMT kind of tech, media, telecoms market has always been strong in the UAE and continues to be that. But you see a lot of those occupiers, they're more established. They've been here and matured. So there tends to be a little bit less activity with them. They can afford to be a bit more patient. Whereas in the financial kind of services sector, particularly in the DIFC, we're seeing, newer entries, less mature kind of businesses that are here that are now having to kind of face the music in terms of these higher rents and they have to pay these higher rents in order to make. Are they
surprised by hearing these rents, knowing that?
No, not necessarily, because I mean, they're coming from the likes of Manhattan where, it's slightly comparable rents. 5 years ago and beyond for Dubai, when they looked at Dubai rents, they definitely had the opinion that it was very affordable. So it's not that it's unaffordable and it's not a surprise to them. It's more of a surprise to those that have existing infrastructure.
Yes.
The renewals that are coming around now, it's hard to get your head around for people that don't sit here.
Yes.
You're just looking at numbers. These corporates have a lot of due diligence and kind of approval processes that go into a decision. So you have to justify with a lot of data to
There's
back
an
up.
education process, right, where you're guiding them through and saying, yes, you may be surprised that there's 20% year-on-year increases, but that is the market, right? So I think we get asked that question a lot locally as well, is how sustainable is this, that it's 20% year-on-year forever? It's probably not that sustainable, that it's 20% year-on-year forever, but I think that it's just a reflection of the supply. I think we touched on it earlier. The supply will come, and the market will eventually change because all markets go through cycles. But unfortunately, at this stage for your global clients, we're just in a challenging scenario, right? But it won't be there forever. I think that's probably some reassurance you can give them.
That's really interesting. Thanks for that. And speaking of supply, can we touch on off-plan sales? Because there's been a noticeable rise in off-plan office sales and leasing activity.
Yeah.
And what's driving that trend? Where is it most prominent?
Yeah, so I mean, off-plan sales have really come from almost nowhere. So I've been here since 2006, and there hasn't really been an off-plan commercial market for about maybe 8 or 9 years.
Wow.
But however, recently in the last 2 to 3 years, it's really bounced back, if you can say. There's a lot of pent-up demand for people that had to look at older stock, grade B or grade C buildings. They've been waiting to buy grade A commercial office space off-plan. That opportunity hasn't been there until recently. Predominantly, it's in the freehold areas, so Business Bay and Jumeirah Lake Towers, both from investors and end users. And I think it's just a reflection of the pent-up demand to buy grade A space that hasn't been available for the last maybe 7 or 8 years, and potentially people diversifying away from residential. Maybe their portfolio is quite residential heavy, and certain investors will say, look, I would like to dip my toe into this commercial market. And I think that's really driven it. I know you don't see that in your Global Occupier Services world, but
no,
yeah,
not so much on a day-to-day, but, we certainly see it. We see the residential sector has, by and large, been the large focus of many investors over the last 5 years. Or commercial, maybe more of an afterthought. So now, we're at this supply and demand pinch where we're at sub 2% vacancies in a lot of the major sub-markets. Those investors are now realizing the returns that you can make from commercial space because of the imbalance is much higher than you can now get in the residential sector.
I think, people will also look at commercial and say, look, I can potentially get a tenant that's a corporate, and they'll sign a 3 to 5 year lease. And like residential, where there's a bit more risk and it's a 1 year lease, it's more structured. So I think they're looking at that again and saying, maybe I should not have all my eggs in one basket with residential, and I sort of split my investments and look at commercial as well. Yeah.
Great. Strata.
Yes.
We talk about strata
Yes.
owned versus single owned office buildings, and how do they affect the future of the office landscape?
Yeah, it's a big topic kind of in the corporate tenant rep world. Single owned has always been the preference for many reasons, and strata has present many challenges to multi-corporates. Within a strata development, you have multiple owners with differing rent opinions. I wouldn't say all the time, but typically the management of these buildings, are inconsistent. There's no single point of contact. So for multinationals, they're looking for more of a partner than a landlord. They're looking to work with someone, if they need to grow and expand or potentially downsize. So you can't do that in a strata development when you've got a different owner to your right, to your left, above you, below you. It presents many challenges in that
Would
respect.
they actually say to you, we won't consider a strata building?
Typically from the off, but we're in a unique position now that there's spillover into strata because all the single-owned assets naturally are the most in demand, command the higher rents. They're all 100% occupied, so the strata market is sort of being forced upon at the moment. When that new single ownership demand comes and it suits those in the certain jurisdictions that they have trade licenses, then I don't think strata is going to be part of the equation.
Yeah, I agree. I think all things being equal, most tenants, both local, regional and global, would rather look at a single landlord building for all the benefits that you discuss, single ownership, management of the building. However, Dubai is built on also SMEs in the strata world. I think there's room for both.
There's a time and place.
There's a time and place and there's room for both. And we need both because you want investors to come in and buy as well. And that's where the strata world sort of helps out. But I think, from your side, also because it's free zone and most free zones are probably single owned.
Yeah.
There's less demand for the strata.
Yeah.
With local, regional, that's what greases the wheels and keeps Dubai moving. So there's definitely room for both, but challenges as well.
Well, this has been great. I've really enjoyed and learned a lot from this conversation. Thank you both. I guess before we wrap up, if you were to leave our audience with one key takeaway about the Dubai office market heading into the next 12 to 24 months and beyond, what would that be?
Yeah, I mean, if I'm talking to an occupier, I would say plan early or pay later. You want to be looking at the future deliveries. You want to be looking at your headcount forecast of the medium to long term, so say 3 to 5 years. You don't want to be caught out with a last minute decision with a fragmented office portfolio. It doesn't really support collaboration and office culture.
I would love to be able to say local and regional clients have that 3-year time frame to plan ahead. Unfortunately, we probably get more like 3 to 6 months within local agency work. So yeah, but I think that's probably the right message to office tenants, is to plan ahead. Know your head count, know where you want to be within reason. I think on the other hand, for landlords, it's to really see your tenant as a partner. Because when the supply hits, if you don't have the best relationship or you've been opportunistic in the last 3 to 5 years with your tenants, when the new supply comes, you may find your tenant isn't your tenant anymore, right? So I think for landlords, the message would be have that long-term view of how you treat a tenant, how the relationship is. It's a relationship. Yeah. I think once the lease starts, that's the beginning, right? So sometimes we say that's the easiest part, although it's difficult to get a lease signed, then the relationship starts. Then you're a tenant for 5 years. How do you treat that tenant? So take care of your tenants. I think if I'm an investor and I'm looking to buy, it would be do your due diligence, look at the developer, who are you buying from, where are you buying, which part of the city, know who you're going to be catering to. Make sure you're buying on a price per square foot that makes sense when the supply comes, not a price per square foot that makes sense today. And if you're looking to sell, it's a good time to sell. Is it the best time to sell? I can't promise you that, but it's definitely a good time to sell. So I think we've covered all the bases there, right? Tenants, landlords, buyers, investors, and sellers as well. Yeah.
Fantastic. Well, it's been great having you both here today. Thank you very much. And everyone else, thank you very much for tuning in today. See you next time for episode 3 of Conversations.